Do you want to know how to legally defer taxes on the sale of your investment property? In this video, I will break down the 1031 exchange, what it is, how it works, and why it could be a game changer for your real estate investments. Stick around to learn how you can save big and maximize your returns. Thank you for watching. My name is Leslie Simpson, and I am a realtor serving North Idaho and Spokane County. I make videos on life and real estate here in North Idaho, and I upload once a week. Take a quick moment to subscribe so that you don't miss the video. If you are thinking of making a move to North Idaho, I would be happy to connect and talk about your move and what you're going to be looking for in your next home. Back to business. Do you dream of being a real estate investor? Whether you have a whole portfolio of rental properties already or if you are just beginning, watch this video to learn how to maximize your investments and grow your portfolio using a tax-deferred 1031 exchange. A 1031 exchange is a swap of one investment property for another that allows for capital gains taxes to be deferred. Referred to by its namesake, IRS Code Section 1031, this bill was passed in 1921 to encourage active reinvestment by giving an investment real estate person the ability to avoid taxation of ongoing investment property. The primary benefit of a 1031 exchange is the obvious tax deferment. With a 1031 exchange, you can defer taxes on the investment properties you own or manage indefinitely until you sell, exchanging from one property to another. Occasionally, investors want to sell their investment properties and purchase a new one. Sometimes they want to consolidate their assets. For example, buying an apartment building instead of managing multiple one-off rental properties. Or perhaps you have maxed out the tax benefits of your property by depreciating the asset year over year, and it's time to sell it and buy another investment property so that you can start that whole process over again. That's a different topic we should talk about later. One more example, perhaps you live in a state where the landlord laws are not very favorable to the landlord, and you want to move your investment portfolio to a state where you have more rights as a landlord, like in Idaho. If any of these scenarios speak to you, then you might want to consider a 1031 exchange so you can cash out and move on to the next investment property with limited taxes. Like I said earlier, a 1031 exchange is a swap of one investment property for another that allows for capital gains taxes to be deferred. An exchange can only be made with like-kind properties. The IRS defines a like-kind exchange as occurring when you exchange real property used for business or held as an investment solely for other business or investment property that is the same type or like kind. Properties are of like kind if they are of the same nature or character, even if they differ in grade or quality. Real properties generally are of like kind, regardless of whether they are improved or unimproved. For example, an apartment building would generally be like kind to another apartment building. If used correctly, there's no limit on how many times or how frequently you can do 1031 exchanges. Another important consideration is that your replacement property needs to cost as much or more than the relinquished property, or else it becomes a partial exchange. A partial exchange entails receiving cash, excluded property, or non-like-kind property on the replacement property, as well as an exchange of qualified like-kind property. In case of a partial exchange, tax liability would be incurred on the non-qualifying portion, and capital gain would be deferred on the qualifying portion. Let's cover a few definitions that come up a lot during 1031 exchanges. First, QI. This stands for a qualified intermediary, or the entity that acts on behalf of the taxpayer. This person has no economic interest except for an exchange fee for facilitating the exchange. The QI could also be known as the accommodator, the facilitator, or just simply the intermediary. Second, exchanger. That is you, the investor. 3, relinquished property. That is the property you are selling. 4, replacement property. This is the new property that you are acquiring to replace the replacement property as your investment property. There are 2 key timing rules you have to observe in order to do the exchange successfully. First, identification period. This is the period of time during which the exchanger, you as the investor, must identify potential replacement properties in your tax-deferred like-kind exchange. The period is 45 calendar days from the date the deed is recorded on the sale of the relinquished property. By that 45-day mark, the exchanger has to turn in the identification form that the 1031 agency is going to send you. There is normally a 3-property rule to identify 3 potential replacement properties. Second, the exchange period. This is the period of time during which the exchanger must complete the acquisition of the replacement property. This period is 180 days from the transfer of the deed of trust of the relinquished property. So from the day the deed is recorded in the new owner's name for the property that you are selling, you have 180 calendar days to close on your replacement property. What is a reverse exchange? A reverse 1031 exchange occurs when you complete the purchase on the replacement property prior to closing on the relinquished property. A reverse 1031 exchange is actually set up as an LLC. It is much more complex and expensive, but it's not as expensive as failing the 1031 exchange timelines and having to pay those capital gains taxes. The simplest and best way to do it is just sticking to the proper order of events. Step 1, sell your relinquished property. The funds are held in the exchange. Step 2, close on the new property within 180 days from the date the deed records of your relinquished property. An added perk to doing 1031 exchanges is that you become a favorable buyer. Being a 1031 exchange buyer is very similar. It's basically the same as being a cash buyer. Sellers love this as long as they understand it, as long as their listing agents are educating them about the process. As a buyer, you can typically close sooner than the buyers who are using financing, and sellers appreciate that there are less hoops to jump through in the transaction. If you have any questions about this topic or want to talk about the real estate market here in North Idaho, please reach out to me using my contact information in the description down below.